We're talking about the halftime report. We're a little past the halfway point here in the year at the tail end of July. And I just want to show you visually what's really happening behind the headlines and what you may be hearing from other peers or other operators. What's happening now, what's forecasted to happen in the future. I'll go ahead and kick it off with the disclaimer page. Not financial advice, not legal advice, not tax advice. So please seek licensed financial advice. Okay, this is for informational and educational purposes only. So on the agenda, we're going to talk about what's going on with multifamily rents, a pivot point with interest rates, new construction, and occupancy and vacancy, and then we'll go into how investors are moving in Q3. So with that, a little bit about us. If you're not a current investor or not familiar, Ashcroft Capital, we are headquartered in New York City. We do not invest in the state of New York. We are Sunbelt investors. So you can see here the map of properties that we own through Florida, Texas, Georgia, and North Carolina as well. We've taken 28 deals full cycle through the business plan. That means we bought them and we renovated them and we sold them. And that's averaged out to be about a 22% limited partner return net of fees. Birchstone Residential is our in-house property management company. They have one client, that is Ashcroft Capital. We also have Birchstone Construction in-house, which is our construction management company, if you will. Now, when I say construction, not to be confused with new construction and new development, we do not do that. We always buy pre-existing occupied cash flowing properties, 65 plus years of executive experience there at the top and 100 million projects completed. Last but not least, we also have Sure Home, which is something that really sets us apart. Sure Home is basically overseas. We're having custom designed materials created exclusively for our Ashcroft properties. And that also comes with a pretty hefty discount. With that out of the way, hopefully that gives you a good idea of who we are and what we do. Multifamily syndicators in the Sun Belt, value add business plans, Class B and A- properties. I'll start with the basic and the obvious. What are rents doing? It's been really tough to push your rents higher when you've got a neighboring property coming online, A-class luxury, discounted rents so that they can fill up their units. It's pretty hard to get, the rent increases that we were seeing in 21 and 22, for example. But albeit we are on an increase, so Zillow's anticipating about 1.6% of annual rent growth this year. Yardi Matrix just short of that at 1.5% nationally speaking. Now, obviously real estate is local. Every market's different. Some markets are having 5% plus rent growth, while other markets are seeing negative 5% rent declines. So it's really going to be dependent on the market that we're talking about. Now, the Fed, 8th consecutive meeting here where they've held these rates at 4.25 to 5.5 at the federal funds rate. Still divided and still undecided, but ultimately you can see the dot plot here on the left of the screen. Rates are still anticipated to come down. But the bottom line is we're not a group that is focused on tomorrow, next week, or next month, right? We're always looking out years ahead. We're buying properties today with typically a 5-year business plan in mind. So these fluctuations don't mean a whole lot. There might be an opportunity for us in the future to refinance and kind of reset some debt in a very positive way. But, if rates stayed exactly the same and didn't do anything for the next 5 years, we're going to be fine because we're underwriting for those types of scenarios. You can see here on the right, this is a Statista chart. When rates come up, financing gets a lot more expensive, and that's why pricing has come down. Let's be real about the situation the last 2-3 years. It's really been a capital market cycle shift. So when you think about it from a new buyer perspective, if your debt cost just went from 3% to 6.5%, more than double in just a couple years, that's a huge cost that you have to consider in order to cash flow a property. So in other words, if pricing never changed, but rates went up double, nothing would really cash flow, and therefore no one would really invest in multifamily. So the bottom line is this, in our opinion, is a great time to be investing as these deals are 25-30% down. It's not so great for pre-existing deals that you may be holding. It's a shopping opportunity if you're in the market to do so. The loan pricing today, it depends, of course. We've gotten more competitive pricing than what you see here on the left, but 6 to 6.5 is pretty typical. And we're seeing an increased investor appetite for fixed income alternatives. We do have one of those. It's the Ashcroft Income Note. And also we've seen a big macro level shift to a flight to quality, like Class A, newer vintage properties. And the reason is that's all that's been built. So from boom to balance, we had this massive boom through 2021 and 22, and frankly, the 10 years leading up to that. this boom really started about 2012. And realistically, it went to about 2022. And as we all know, markets typically go in about 10-year cycles. It depends on the asset class, but that's basically what's happened. So completions are down quite a bit, roughly 28% from last summer's peak, according to the U.S. Census Bureau. Permit activity has dropped sharply over most U.S. metros. Developers cite underwriting challenges, higher construction costs, and deterrence to new project launches. Makes sense. I think we all kind of know that. Orlando, one of the most active multifamily markets during the last cycle, now experiencing a pronounced pullback in new construction. Starts falling by roughly 60% in 2024. Completion slowing in 2025. Guys, this is really, really important because one of the fundamentals to investing in real estate, I don't care if we're talking about single family, multifamily, self-storage, mobile home parks, is supply and demand. And so in this moment, and over the last 18 months in particular, we have seen a tremendous amount of new supply overwhelming the market. That was 2021 and 2022 when things were just skyrocketing and we were seeing 10 to 15% rent bumps and just things couldn't get any better, or so we thought. So developers started jumping in saying, we want a piece of this pie. We want to be profitable too. And so as they're sitting there building, the prices have come down rapidly and inflation has gone up and interest rates have gone up. All of that product is hitting the market now and flooding the market, quite frankly. So that is a huge dynamic to consider. But what's important is what I'm saying here with these slides, what we're showing is that the new build construction, the new permits for the future are on a rapid, steep decline nearing 2010 levels after the Great Recession. There's still not enough, believe it or not, there's still not enough housing nationwide to the tune of millions of homes and or apartments. And so it's only going to get worse here with these developers pulling out, sitting on the sidelines and waiting for a better time to continue building. Absorption trends, 294,000 units were absorbed in the first half of this year. So that puts the market on pace with 2021 strong post-pandemic recovery. So it's a very, very, very strong year. Also, occupancy's been holding strong between 94 and 95% through Q2. You can see the fundamentals are there. Okay, these new apartments flooding the market are getting absorbed at rapid rates, which is a very, very good sign. I think we all know single family homes have priced out a lot of people, not just because of interest rates, but pricing never really came down. In fact, in most markets, it's continued to go up. So your mortgage payment may be 2 or 3x what it was just a few years ago with no relief on pricing. So occupancy is poised to stabilize about 94%, finding its equilibrium. Strong absorption suggests that demand is robust as the pipeline delivers. Deals, debt, and discipline. So as transaction activity remains robust. So what's happening here is I'm glad that you all are on this call because you're likely an individual, accredited investor like me, and you're what I would call a Main Street investor. And what we're seeing right now, which happens every cycle, are these huge institutions are coming in to buy up this multifamily product. You're seeing Blackstone and BlackRock and KKR and JP Morgan. You're seeing so many groups, I could go on and on, that are buying the inventory up while a lot of Main Street investors have been remaining on the sidelines waiting to see. And so I hope that this presentation and research of Ashcroft brings you to a conclusion that maybe this is kind of a great dip opportunity. You know, nobody has a crystal ball, but hopefully this data will bring us to that conclusion. So Q1 absorption in markets such as Atlanta, which we operate in, by the way, have surpassed 56,000 units, matching the sum of 2021 to 2023 combined totals. Dallas-Fort Worth, another key market of ours, it is picking up. My candid opinion that we're on the midst of a turnaround here. As you look at 3 or 4 quarters or an entire year, you start to see this turnaround happening and these cap rates compressing and these interest rates slowly but surely turning around. And even when they cut rates, it usually takes 6 to 12 months to see that full effect of that repercussion, so to speak. We already talked about the loan rates there, and the average LTV is 55 to 65%. What that tells you is that lenders have gotten more, conservative, and so have operators, and so have we here at Ashcroft Capital, not only using fixed rate debt versus any other form of floating rate with with caps or something like that. We do equity and we have debt offerings. We do 4 to 7 year hold periods. And then we do value add business plans and we target cash flow plus equity upside potential. Now that wouldn't apply to the debt term, but for our equity deals, it's that combination. I'm going to wrap it up there. Thank you guys so much for your time. I appreciate you being here tonight. Look forward to speaking to you as our team does as well. Have a great week and we'll talk to you very soon. Thank you.